Nearly $8 trillion is sitting in American money market funds. The popular theory says this money is waiting for the Federal Reserve to cut rates. Then it floods into stocks, prices explode, and everyone who stayed in cash watches the rally through the window. But there is a problem with that story. The money is not waiting, it is already invested. Most of it is financing government securities and government-backed lending markets. And if rates fall, stocks may not be the first or even the biggest winner. So what happens if $7.9 trillion starts moving? Where could it go? What happens to banks and government borrowing? And why might the reason for a rate cut matter more than the cut itself? Because the cash pile is real. The story being told about it is mostly backwards. On July 15, 2026, American money market funds held approximately $7.89 trillion. Around $6.51 trillion sat in government funds. Another $1.24 trillion sat in prime funds, while roughly $146 billion was held in tax-exempt funds. The total was down about $60 billion in 1 week. That sounds dramatic until you realize it was less than 1% of the pile. The Federal Reserve also reported that money fund assets had climbed from roughly $7.2 trillion at the beginning of 2025 to about $7.9 trillion 1 year later. Why did so much money pile up there? The short answer is yield. The Federal Reserve's policy rate is currently between 3.5% and 3.75%. Money market yields usually adjust quickly when short-term rates change. Ordinary bank deposit rates often move more slowly. Apparently, people prefer earning more money to earning less. Economists continue investigating. But a money market fund is not a warehouse filled with dollar bills. When you put money into a government fund, the fund generally buys short-term Treasury securities, government agency debt, or repurchase agreements backed by government securities. A repurchase agreement, or repo, is essentially a short, secured loan. One institution receives cash, provides securities as collateral, and reverses the transaction later, often the next day. Prime funds can also finance companies and banks through commercial paper and certificates of deposit. Tax-exempt funds buy short-term municipal obligations, so the $7.9 trillion is already working. It finances government debt, short-term lending markets, businesses, and municipalities. Cash on the sidelines makes it sound like trillions of unemployed dollars are standing outside the stadium. In reality, the cash bought a ticket hours ago and is financing the stadium. Higher interest rates made this arrangement unusually attractive. For years, cash paid almost nothing. Then policy rates rose, Treasury bill yields followed, and investors could earn meaningful income without accepting the price swings of stocks or longer-term bonds. Banks made the choice easier by failing to pass every rate increase to depositors. Federal Reserve researchers studying 30 years of data found that the yield difference between money funds and bank deposits significantly influences where people keep their cash. When money funds pay substantially more, money tends to leave banks. When that advantage shrinks, some can return. But here's the detail that destroys the $8 trillion stock market fantasy. Much of this is not speculative money. Companies use money funds for payroll, taxes, acquisitions, collateral, and operating expenses. Investment firms hold cash while waiting for deals. Households keep emergency savings and home deposits there. This money needs to remain liquid regardless of what the S&P 500 is doing. Paying next month's salaries with a basket of speculative technology stocks creates unnecessary tension in accounting. Now for the biggest myth. Suppose an investor withdraws $100,000 from a money fund and buys stocks. The fund sells a Treasury bill, lets a repo mature, or chooses not to reinvest. The investor receives the money and buys shares, but the seller of those shares now has the cash, and it did not disappear. It changed owners. The entire $7.9 trillion cannot pour into stocks like water filling an empty pool. Every buyer needs a seller. Prices rise when buyers become more eager than sellers at the current price. The price moves until someone agrees to trade. Money leaving funds can still increase demand for stocks, bonds, or property, but someone will continue holding the cash and someone must own the short-term securities the fund previously held. The real question is how much money changes strategy, how quickly, and which prices must move to attract the other side of the trade. There are four possible outcomes. First, rates remain relatively high. If money funds keep paying attractive yields compared with bank accounts and inflation, there is no reason to expect a mass exit. Investors continue getting paid to wait. Funds keep buying Treasury bills and participating in repo markets. Banks keep competing for deposits. The Great Migration remains a documentary that never gets past the trailer. Second, the Fed cuts rates gradually while the economy remains healthy. Money fund yields fall as existing securities mature and are replaced with lower-yielding investments. Some money returns to banks, some moves into stocks. But bonds may feel the effect first. Investors can move into intermediate or long-term bonds to lock in yields before they decline further. Bond prices may also rise as market rates fall. Stocks still need earnings and cash flow. A lower cash yield helps valuations, but it does not transform every unprofitable company into a good investment. It simply improves the lighting around the spreadsheet. Third, the Fed cuts because the economy is deteriorating. This is where the bullish story can fail spectacularly. Rate cuts are not always a celebration. Sometimes they are an ambulance. If unemployment is rising, profits are falling, or credit markets are under pressure, investors may keep money in safe funds even as yields decline. Companies preserve liquidity. Households become cautious. Investors choose safety over the possibility of higher returns. The yield falls, but fear keeps the balance high. The reason for the cut matters more than the cut itself. Fourth, inflation remains stubborn and rates stay higher for longer, or rise again. Then the cash pile could remain large or grow. Short-term yields stay competitive, and riskier investments must compete against an asset offering liquidity and income without requiring a heroic forecast. But there is another player in this story that almost nobody mentions: the United States Treasury. For the July to September quarter of 2026, the Treasury estimated that it would need to borrow $671 billion in privately held marketable debt. Money funds are natural buyers of short-term government obligations. If investors redeem fund shares, the government does not suddenly lose the ability to borrow. Banks, pension funds, foreign investors, households, or other funds can buy the securities instead. But yields may need to become more attractive. Large outflows could reduce demand at the short end of the Treasury market. Less demand at a given price generally means higher yields are required to find new buyers. More demand can push yields in the opposite direction. Then there are banks. Money returning to deposits can give banks a larger and potentially cheaper funding base. That can support lending and improve liquidity. But banks may need to offer competitive rates to win the money back. Customers have discovered the yield button in their banking apps. Pretending it does not exist may be less effective than it was 10 years ago. So, who benefits if the pile moves? Bond funds could benefit as investors extend maturities, banks could regain deposits, stocks could receive additional demand if growth remains intact and lower safe yields make valuations easier to defend. Housing could receive support if market rates and mortgage costs decline, although affordability still depends on home prices and incomes. Asset managers earning fees on trillions in money funds may prefer the cash stays exactly where it is. Other managers would happily welcome it into bond and equity products. Wall Street is remarkably flexible about its economic convictions when the alternative pays a management fee. If you want to know whether the $7.9 trillion is genuinely moving, watch 5 signals. First, weekly money market balances, separate government, prime, retail, and institutional funds. 1 week can be noise. A sustained trend matters. Second, the yield gap between money funds and bank deposits. If funds continue paying more, the incentive to leave remains weak. Third, Treasury bill yields and expectations for the federal funds rate. Markets usually move before the Fed announces anything. Fourth, flows into bond and equity funds. Falling money fund balances mean little unless we know the destination. And fifth, why rates are changing. Gradual cuts during stable growth create a completely different market from emergency cuts during a recession. The $7.9 trillion matters. It affects government financing, banks, short-term rates, asset management revenue, and the relative appeal of almost every investment. But it is not rocket fuel sitting beside the stock market. It is hydraulic fluid already circulating through the financial system. Changing rates can redirect the pressure, but the money does not vanish from one container and appear inside stock prices. The next major market move will not be determined by whether this cash enters the market. It will be determined by why investors change what they want to own and how far prices must move before someone accepts the other side. So if your money market yield fell below 3%, what would you do? Stay in cash, buy bonds, buy stocks, or pay down debt? Put your answer in the comments. That decision, repeated by millions of people, is the real story behind the $7.9 trillion pile. This video is for educational and informational purposes only. It is not personalized financial, investment, legal, or tax advice.